we should start.
Yep, we're just going live now. Right, just give people a second or two to filter in. Okay, hello everybody. I know people are just filtering in, but welcome to today's webinar on how to get started with investing. Your host today is Peter Six. You can see him here on screen with me. And I'll just flick over to the slides. Yeah, so this is your host, Peter. You can see you're in safe hands by his bio here. Peter's a former floor trader. He's worked as a professional market maker. He's co-authored 2 books about investing. And now he works as an investment coach here at Saxo and is your host today. Just before we start, there's a couple of things I want to flag to you, actually. So number 1, the slides are available for download. So the slides that Peter is about to present, there's a handout section, likely on the right-hand side of your screen where you can download them. Also there, you can ask questions. So feel free to put them in as we go. And the last 15 minutes of the session, we'll pick up those questions at the end. And then finally, if you do want to watch the replay of this, if there's anything you didn't catch and want to pick back up, the same link you just used to join can be used to watch this same session on demand anytime. So you can watch it later today or tomorrow or whenever you wish. So with that, I'm going to flick you back over to Peter, who can take it from here.
Thank you, Luke, for this warm introduction. Yeah, maybe it's good that I spent a couple of words of who I am, and maybe that it's the co-authoring of 2 books about investing. You probably know the Dummy series, Horse Riding for Dummies, Computers for Dummies. There's also Investing for Dummies. And my colleague and I wrote the Investing for Dummies for the Dutch market. I'm based in Amsterdam, and Holland is where I live. Before we start, this is the disclaimer. It's for educational purposes, this webinar, and we don't give any advice whatsoever. If there are shares being mentioned, it is just to illustrate an example. The agenda for today is why invest, what is investing, what are different investment types and sectors and styles, understanding risk profile and portfolio allocation, and be aware that there will be about building up your portfolio. It will be a separate webinar. Also, the platform walkthrough, I probably will skip that. And I can already say, and I will repeat it at the end, at the 21st of February, there will be a platform walkthrough when it comes to Saxo Investor. That's our most easy to use and intuitive platform on the 21st of February. And on the 6th of March, there will be a platform walkthrough for Saxo Trader Go. And that is the web-based, more trading-like platform we are offering. Why invest? I think that the first bullet says it all. If you look to the long-term returns of investing, they beat savings. And I know it is at this moment in time not sure how you will get to that better return, because stocks are volatile and they will move, and there are always movements in the financial markets, opposite to a savings account. And whenever you log in, you will see the same amount of money plus the interest you earned. But if you look to the long-term differences, it is you see that investing beats savings. There are 3 rules you must stick to, and that is keeping the cost low, diversify well, and do it for the long term. And when you think about the attractiveness of a saver, is that it feels very secure, and it is also very secure. But if you look to the long-term returns of savings, and even if they are corrected for inflation, then it is getting close to zero. And then long-term investing really does make sense. But if you know now that you have to spend quite a large amount of money because you will buy a new house in a year, my advice would be keep it in your savings account, because you know you're going to need the money within 1 year, and you can't say anything for sure about investing for a period of 1 year. If it would be 15 years or 20 years, then it would be wiser to say, all right, I start investing. If it is on a shorter time frame, it makes more sense to keep that in a savings account. So the two-step approach: enough savings for the short-term expenses and a little bit extra, and enough investments for the long-term goals. And sometimes people ask me, yeah, but does it make sense if I would invest? They say, I'm saving 500 USD, pounds, euros, or whatever. Does it make sense if I would do that, if I would keep on saving those 500? I think that you can also make it a 50-50 approach. You keep on saving, and you also start investing with half of that amount. So it's not a question of should it be the one or the other. No, I think it is very wise to do both. And especially, I repeat myself, but especially for the long term, it is about investing. And I know that this is quite a hurdle for people to take. And what helps if you start doing it chunk by chunk and with relative little amounts. Because one of the things you have to get used to being an investor is that the kind of money on your investing account, it will fluctuate. It will differ from day to day. And that is something you want to get used to. And if you want to get used to that, do you want it with 100,000 or do you want to do it with 3,000 or 5,000 or 10,000? So with smaller amounts, it's a good way to getting used to the volatility of investing. Now here we see it. This is after taxes and inflation. You see it in the graph on the right hand side. After inflation is deducted, on average, on the long term, stocks will generate around 5.5%. Bonds, government bonds, only 0.6. The bills, you can compare, that is short term bonds, 3 months. You can compare that with savings. You end up negatively. And I think this really makes the case to say, yeah, if it is for the long term, I should be investing. And it is a switch in your head you have to make, and also think a little bit for yourself about what is my fear. And probably your fear is losing the money you will invest. And then what helps? Diversify well, and second, be in it for the long term. If people say, yeah, I would like to try investing for a year and see what comes out of it, and if it is positive, I will continue, and if it is negative, yeah, I will stop. That time frame is just too short to make that decision. Look to the longer time frames, and then you will see that investing beats savings. Example 1 on the left hand side: lump sum investment of 20k will grow to 76,200 in 25 years. In 40 years, it will go to 170. If you do 500 euros monthly, it will grow to 310,000 euros in 25 years. And after 40 years, it will be almost 850,000. So it really emphasizes the long-term importance when it comes to investing. And here you see it is up until August of last year, starting in 1990. Here you see how it works, how it grows. Left on the downside, you see the amount invested was 10k, and the net asset value was 108,000. Annual growth, close to 7.5% on a yearly basis. Here is dividend, the inflation is still in. And you see on the upper left corner that this money was invested in the broadest available basket there is. It was the MSCI World, all countries. So all the countries are in this index. So it is not buying one stock or two stocks. No, you just buy, I would say, very much stocks. I think there are 1,600 stocks in this index where you are where you are investing in. Yeah, what is investing all about? I think that it is putting your money to work. And there is money, and it can be capital already in your savings account. And another way of looking at money is the money I can monthly save. Um, and assume there is 20K already in the savings account, and you have 600 monthly. That is free to invest or spend or save, and you probably do save some of it. That could be a number to start from and say, all right, I will start with a part of my savings, and I will put on a monthly basis a fixed amount of money in that um, in the market. There are a few things to consider. Your goal, that is PPIG, is an acronym I'm going to explain in a sec. What is your risk tolerance and what is your investment horizon? And your investment horizon, the longer, the better. And in my ideal world, if a child is born, the parents or the grandparents, they don't open up a savings account, they open up an investment account. And they put in, can be 100 on a monthly basis. And once the baby grows up, he's 16 or 18 and he has a Saturday job, you can say, all right, this is what we did the last 18 years for you. And we think it is very important you keep on doing this. So you have to put in 50 by yourself on a monthly basis, and we do the other 50. We still keep on doing it. And at a certain point in time, he's got a job. He's 22, 24, at 25, he starts to work. And at that moment, the parents say, all right, we helped you up until here, but now you should do it for yourself. And it's not at the end of all the spending that you see, all right, I still got 100 left, so I'm going to invest it. No, I think it should be priority number one. So it is a fixed cost, that investment. If you would do that, and if you were to stick on doing that, starting when you are born and you do it until you're 64 with a 7% return before inflation, you will be a millionaire when you're 64. And that is with only 100 euros monthly. So the investment horizon, the longer the better. And what you also see, the longer the investment horizon, the lower the risk. If you look to the biggest equity market, and that is the US, the S&P 500. If you look to the time frame in which investments never made a negative return, that is 15 years and 3 months. So in the history of 150 years, if you started investing somewhere and you did it for 15 years and 3 months at least, you never had a negative return. And I think it is a very important insight that emphasizes um, uh, the weight of the investment horizon. What you have to remember, the longer the better. And sometimes people come to me and say, "Yeah, but I'm too old to have that long of an investment horizon." And then you can think of maybe it can be for my children or my grandchildren, if they are there, of course. As said, the three factors that drive success in investing are diversification, and the better diversified, the lower the risk. Keep the cost low, and the third one is long term. I talked about that already. The nice thing is that there are investment products available that have two out of three of the pillars of success in them. And that is They have to be diversified and they have to be low cost. And in the ETF, the exchange traded fund, it's an you can compare it with a mutual fund, but it is just an index follower. It tracks a certain index, and it can be the MSCI World All Countries Index, it can be the DAX Index, it can be the Dow Jones Index, it can be the S&P or the Nasdaq, and so it is an ETF is tracking an index, and it has got no pretensions. It just want to tracks that index for the cheapest price possible. So the costs of ETFs, they are very low. If you would compare it to a mutual fund, and they can be higher. A mutual fund can be somewhere between 0.6 and 1.5%, or even higher. And mutual funds, you can start buying from a cost perspective from 0.05, 0.1%. So that really makes a difference, especially in the long term. So what I'm saying is that in the 3 pillars of success, there is a product that carries 2 of them, but what you have to bring for yourself, that is the long term. So for me, investing is also about a long-term commitment. And I think it should be part of your financial household book, your bookkeeping. It should be part of it. And I'm not in favor of people saying, yeah, I would like to try it for a year and see what happens. By the way, there is a 75% chance that the return in 1 year will be positive, but that's only a 75% chance. If they would commit to a 15 years and 3 months commitment, there's never been a period in the American history that the outcome was negative. Now, and then reasons to invest, and it's an acronym, PPIG, and those letters that they stand for something. The first one, and I think that is important, that is the preservation of your capital. And you can even think of preservation of your capital. Assume that the savings account doesn't pay you any money, but you do have a little bit of inflation. Then you know you're going to lose money over the coming year. So preservation, that is number one. Then you got the I, and that stands for income. Income out of your investments. And when you're young, it's not that important. But if you're getting to the more when you're getting older, it is very nice that you have some capital which you invested and that supplies you with a monthly or a quarterly income. So that is also important. For the youngers, there is the G, and it stands for growth. If you're young, there is not, the capital is not already available. You need it to grow. Because the investment horizon is long, the young people, they're also able to take more risk because they still got time to recover if the market would go down. So we got the preservation, income, and growth. But I mentioned also another P. Well, and the first P stands for play. And what I mean with play, that is not like online gambling or something. For me, it can be an intellectual play that you think about what will be the main themes for the coming decade or coming decades. And is it possible to have a view on the world and invest in that? So it becomes an intellectual play. And some people really enjoy being in the market quite often, and they want to anticipate and they want to profit from the short-term movements in the market. Then you become, you get into the trader side of investing. But also for a long-term investor, I think the play part, that is the part where you color your portfolio with themes that are important for you and where you have a certain view on, and you can see that reflected in your portfolio. I will come up with an with an example of that. So preservation, income, growth, and play. That is PPIG. And what you can imagine, I explained it a bit already. If you're young, and you tilt towards the G, you tilt towards the growth. If you are in the autumn of your life, preservation will be more important and income will be more important. The P of play can be on all ages. And what we see, for example, in our client base is that also people that are older um, and they are investing for quite a long time, they still also like the play part of it. And they like to be diving in an annual report, read it, and see if there are possibilities in their view to invest in a particular company. So that is the intellectual play part of investing. Risk profile. And, there's one sentence bold and in italic, and this is it is the nasty part of investing. Um, because you will be in the market for a longer time, you will experience one day or the other, you will experience a severe drop. If your long-term commitment is strong, you won't be happy, but you will stick to the plan. You stick to your investment plan and you will be in the market because history shows us that the stock market always has recovered. But the emotional reaction to a big drop in the stock market could be, oh, I'm losing everything. I must sell to keep the remains of once were a bigger amount of money. Um, and what I more or less say is that you will experience it, but stick to the long-term plan. And what I'm saying in the text is that there is an if you say to people, yeah, no, I think I can handle it, a 25% decline in my portfolio value. But if you're investing with 100K and you lose in, let's say, 2 or 3 weeks because there is a crash-like scenario, you're losing 25% of that. The question is, can you really still be that more or less relaxed about the loss you are making? So there is an imaginary where you say, 25% drop, I can handle that. But maybe if you're -10 or -14%, you start to sleep not that good at night. So that is your real risk profile. So be aware of it. And there will be a time where the stock market will decline. Also here, the long term is important. A way, what you also see in your risk profile, if you're young, you're really overweight equities. And I think if you're 25 or younger, 100% equity portfolio, that is really defendable. So the only thing you invest in, I mean, you diversify as well, but it is only in stocks. If you're getting older and when the preservation part of PPIG becomes more important, you will probably switch over or increase the amount of bonds. And they are less risk, also some less return. So you're bringing the risk profile of your total portfolio down when you are getting older. So it is something that changes over the years. And that said, I know a lot of clients, if I would take the approach very theoretical, they are really, really overweight in equities. They should be for 80% or 90%, they should be in bonds. But they say, yeah, but I like it. I like to go to an annual meeting. I like to read about a certain company where I have a certain connection with. So it's for them. It's on the play part that stays on the side, or that is included all the time. Then investment products, and I start off on the left hand side, uh, on the upside, savings. It is safe. Um, it won't fluctuate. You only can add the interest, and that's it. And we see on you see the colored bar. I mean, green is safe and red is more risk. And you have to find the place where you want to be and what fits with you. If you want to have a little bit extra than savings, and it was in Q1, Q2 of last year, was that really an issue because the savings on the US in the US were still very low, but the money market funds were giving a much better return. It's a little bit more risk, although almost regarded as being riskless, the money market funds. Um, the next step would be the bonds. Um, and those are obligations that you enter into if you buy a bond, you know that you will receive the coupon yearly, and at the end, at expiry or at maturity, you will get your money back, and the bond is being paid back at 100%. The most secure are the government bonds. The next step would be the corporate bonds, and the higher risk bonds would be high yield bonds. And the more we go to the right, the higher the return is. Then you have stocks. I think, at least for the Netherlands, we are a stock trading country. And we really like stocks. If you go, for example, to Belgium, they're much more into bonds. If you go to Italy, they're much more into bonds. So it's also a little bit of cultural where people have more affinity with where they want to invest in. So there's also a cultural part in these investment products. Now, and if you look to stocks, you got the value stocks, and think there of the big names and well established, and they got profits that can be, and you can be certainly certain about. Uh, no, you can be rather certain about their uh, profit growth in the coming years. Those are the blue chips. What also are stocks that are the growth stocks, and they are for their they start to shine in the future. They're now growing, but they will return probably higher profits in the future. So there's a little bit more risk in the growth. Growth stocks normally hardly pay any dividend, where value stocks are much more into dividend. Um, so if we then look at it from a risk perspective that changes over time, for younger people, they will tilt more towards growth. And when you're older, you will tilt probably more towards value. Also, a way of reducing the risk in your portfolio. And the last one mentioned is derivatives. It can be structured products, it can be options, it can be futures. Although that must be said, you can apply most derivatives also um, in a defensive way, but it is a little bit more complicated, and you have to take some time to learn about it. But it is, you trade or invest with a leverage, and I say, if you can't make money in leverage 1, why should you make money with leverage 5? So be very reluctant in using derivatives. Start off with ETFs, very well diversified, low cost, and derivatives can be, it is, I would say, it's another ball game. It is really much quicker than talking about ETFs. What we see here, these are the individual ones, and an ETF can, for example, be a basket of different government bonds. And because it is a basket over several countries, the risk is even lower than bonds in itself. You could also have an ETF on an aggregated uh, level. Then you would have government bonds, corporate bonds, and high yield bonds. It should yield better than an ETF only owning government bonds, but you see that the risk is also a little bit higher. Stocks, um, value ETFs, growth ETFs, mix ETFs of both value and growth. Um, ETFs were grown mainly because they are the trackers of indices, and in an index you got both value and growth. So you got a little bit of both. If if you would say something about the Nasdaq, for example, that is stocks, but it is mostly about growth. So there is some more risk if you would compare it to a more value-based index. Um, Asset classes, you can see that as the categories, um, what you can invest in. As said already, of also a little bit determined by culture. The Netherlands, like said, stocks, bonds, and cash. And in the early 50s, Markowitz, he wrote a paper about diversifying between those three asset classes. Uh, will give you the same return, but with a lower risk. And he got the Nobel Prize for that. What I'm not going to talk about is real estate, commodities, or alternatives. Then, but it are asset classes. You can add them to a portfolio. But for the most people, it will be about stocks. I think that is what is the most appealing, and it feels the most um, close and known for the people that want to start investing. I'm not talking about individual stocks here. I'm talking about stock basket, the ETF, and you can make a choice for the global equity market, for example, the MSCI World or countries. That could be one. If you live in Belgium, you could go for the European equivalent of that, and that would be the Eurostoxx 600 or the Eurostoxx 50 ETF. Um, I think that the color attracts the first attention. What you see here, this is the basic idea of how a portfolio could look like. And what you see in with the blue, the yellow, the brown, and the green, the global equity ETF, global bond, global real estate, and commodities, you see that is the basic portfolio. That is the core portfolio made of 4 ETFs. And sometimes people ask me, but Peter, if I would start investing and I would buy a global equity ETF, a global bond, maybe some real estate, and I don't want to invest in commodities, is investing in those 3 ETFs, because there are only 3 lines in my portfolio, is that well enough diversified? And I say yes, because it's like a Microsoft folder. If you click the global equity ETF, if you click it open, there are 1,000 underlying shares underneath. Nvidia will be in, Tesla will be in, L'Oreal will be in, Unilever will be in, Heineken will be in. So all the big names will be in that global equity ETF. So very, very well diversified. The same counts for the global bonds and global real estate. So with 3 lines in your portfolio, you say, I've got the core of my portfolio constructed only using 3 ETFs. And for quite a few people, that is enough, because managing a portfolio consisting only of 3 ETFs, you can do that in 15 minutes a year. You just have to make sure that you have to reweigh on a periodic way. You have to rebalance the balance between the global equity, the bond, and the real estate. And you can do that 3 or 4 times a year, and that's it. But then it gets a little bit boring as well. So what you can put on top of that, on that core, that are some more specific choices. And this is the place where you express your view on the world. And you could, for example, say, well, with the interest going a little bit higher, I think that the European banks are a place to be. So you buy a more specific ETF that invests in European banks. You also have the same view of the small caps in Asia. They were lagging the market for quite a while, but you see reasons why they would pick up. And cybersecurity, with the world becoming more complex and more connected, cybersecurity will be more important year after year. If those are your views, you can reflect those views into your portfolio, and you see them there. You still make the choice to do that via an ETF, so not one particular stock, and that one particular bank or one particular small cap out of Asia or one cybersecurity company. Say no. One of the things I learned is lower the risk by diversifying. So I pick an ETF, and I do know and I do understand that it is a more specific choice than global equities, but I still want to have the reassurance of a well diversified, and you could say thematic ETF in my portfolio. And then on the highest level, you see the individual stocks. That can be because you have a certain feel with that stock, or you have a certain view on that stock. But it is the most specific stock, or the most specific risk you can take. So if at the lower base, the core, it is still risk, it is still investing, but it is lower because it's well diversified. One level higher, it's still very well diversified in the banking, small caps, and cybersecurity. And the highest level of risk would be the individual stocks. And what we see here, this could be a portfolio of a retail investor that says, I do understand the importance of the core. So there is a big chunk of my capital is in the core. I do have some views about some themes or some trends that will come, and this is reflected in this example with banking, small caps, and cybersecurity. And I also have a number of stocks that I really like and where I really see a bright future ahead, and I also want to invest in those. For me, this is a well-diversified portfolio. Talking about an ETF, I said it is a product with no pretenses. The goal is to track that certain index for the lowest cost possible, and that is passive investing. Low cost. There will be no outliers to the bottom or to the top, compared to the index it tracks. The other approach is active investing, and that is what most mutual funds do. They have an active investing approach. If they would look to the Dow 30, the Dow Jones, they say, well, we got the capabilities to say what will be the outperformers coming year and the underperformers. And from those 30 stocks, I'm going to have a minimal or even exclude them from my mutual fund. and the funds where I think that they're going to outperform, I'm going to overweight them. Then you make, so you could say you make bets on who will do better in the coming year. And that is actively managed. And as I said, most mutual funds are actively managed. If science looks at it, you see that in the long term, it's very hard for active investors to beat the benchmark or to beat the underlying index. And that is the reason why, if you want to keep it simple, I think that ETFs are the way to go. And if you are attracted by the story of the active mutual fund, then you can go for the mutual fund. But they do charge higher costs, and they must and make up first those higher costs, where the costs for the ETF are much lower. And I think it can be, a portfolio can very easily be a combination of the two. I think in the core, the equity, bond, real estate, commodities, I think ETFs is the way to go, because they are global markets. In the more thematic ETFs, could be mutual funds as well, because there is much more sector specific knowledge can be within the portfolio manager at the mutual fund, and because of that he is able to really add value also after the costs. As said, the goal of active, beat the market, beat the return of a benchmark. The goal of passive, that is, I'm very happy when I get the market return where only the tiny costs will be deducted. Individual names versus the baskets, and the individual names are by definition active, where if you would compare that or compare that to the mutual funds or ETFs, it will be also active versus passive. On the active side, there is of course also the play part plays a role here. If you would have a passive portfolio only existing of three lines, the global equity ETF, global bond ETF, and global real estate ETF, yeah, it might get a little bit boring. And if you want to add some play to that, then you can say, I lay some thematic layers on top of that core portfolio. About sectors, I borrowed this nice graph of the Motley Fool. The GICS stands for Global Industry Classification Standards. There are 11, and you see them here. And it is also, and on all of those are ETFs available. And if, for example, your guess is that utilities will do well, you can of course buy one utility company. You can also say, now I'm going to buy the utility ETF because I'm better diversified in that one. But if we look to the returns, and this is from last year, you see that there are big differences. And utilities, for example, over the last 12 months, and this is 2 weeks old, it was -7%. But if you look at technology, just the one above utilities, which is in the upper or the down right corner, technology was up 56%. So you see that making choices can lead to very different outcomes. If you would have said, I put all my money in utilities, last year was a very bad year, -7%. If you would have said, I've put all my money in technology, you had a brilliant year, but plus 56%. But consumer staples and energy, also more or less zero. I mean, you could also say, I'm going to put all my money in consumer staples. So if you look to the total market, it was around plus 18%. So my take would be lowest risk possible, diversify as well as possible, I will take the whole market, and these are on a sector level, the performance over last year. Platform walkthrough. As said, I wanna skip it again. On February 21st, there is a platform walkthrough of Saxo Investor. It is the most easy to use investor platform we have. It's very intuitive. That is on the 21st of Feb, and on the 6th of March, we will have a webinar about Saxo Trader Go, and that's more trading-like webinar. And there is enough information already passed on to you. So I would like to skip it and see if there are some questions. I will come to look in a sec. And maybe it's good to know that Saxo offers 3 platforms. Saxo Investor, I would say the most easy one to use. Saxo Trader Go, it's a web-based application, more for the trader-like investor. And Saxo Trader Pro, that is really for the pros, because if you want to have a cockpit where you do your trading, Saxo Trader Pro, you can have it on 4 or 6 screens if you want, with all the graphs and order books and whatever you want to see. Then you really end up with Saxo Trader Pro. So you pick your own level from where you are and which application you want to use. It will be mentioned in the platform walkthrough. There is a screener, and the screener, it is something where you filter in the universe. If you would filter, for example, in the universe of ETFs, worldwide there are around 10,000 different ETFs available. I think we got around 3,000 on our platform. But you want to only look for equity ETFs. So that's filter number 1. It must be equity. Filter 2 is that it must be world. The third filter is it must be in euros. And then what you do, you narrow down with every filter you give, you narrow the search down. So you start with a lot, and then you say equity, euros. So with every filter you put on, you make the universe smaller, and that really helps you to find your way in the sometimes overwhelming offering there is. Then, of course, it comes to ordering, but it will be shown on the 21st of Feb. How do you put in an order? What happens? How does it look like? What's your portfolio overview? And I think we got time for questions now, Luke. And I hope that there are some questions.
Yeah, cool. Thank you, Peter. Some good insights there. There is a couple of questions, but just a reminder to anyone that is online that you can enter them. So there's a box probably on the right-hand side of your screen where you can add them. And we've got a couple to start with. But let me just ask a question actually first, because I know you talked a lot. This is personal interest really, but you talked a lot about stocks and bonds being kind of important in the portfolio. Mm-hmm. What about other asset classes that, maybe a bit more controversial, like gold or cryptocurrencies?
Yeah. For me, it is about starting with investing. I would stick to the two main asset classes in the stocks and bonds. But if you are a little bit more adventurous and maybe say, but I also want to have some exposure to gold, for example, you can add it. The question then, of course, is also always, but how much of my capital should I invest in gold? And should it be 1% or 20%? Also, depending a little bit on your risk appetite, but an allocation between 3 and 7% in gold can be very well. Cryptos, new, much newer than gold. Gold has been around for thousands of years. Crypto, the same. If you think there is a future for crypto, and I do want to have some exposure to that, you can go all in and only own cryptos, but if the market would collapse like it did a couple of times, and then you are in problems. So also here, decide what is a percentage of your assets that you want to invest into crypto. It can be 3%, 5%. and for the risk takers even higher. But make it in chunks. And I like to approach a portfolio starting in the helicopter, looking down. How much do I want to invest in equities and how much in bonds? And then you're going to divide it deeper and deeper. And then a 60/40 portfolio, for example, that is a term you might read somewhere, that is 60% equities, 40% in bonds.
Good stuff. Thank you very much. Right, let's go to the audience questions. I'll start from the first ones that came in, but there's actually two about taxes. There's someone asking how you save in taxes. So maybe there's some general rules of thumb or not.
Yeah, or not. I mean, this is, and I'm only talking for the Netherlands because in Europe they differ from country to country. For example, in Belgium there is an order tax, you could call it. We don't know that in the Netherlands. So it is really depending. What you could say in the Netherlands, that profits made with investing are at this moment they are taxed lightly, but that will change in the future. But it is really too dependent um, on the country where you are. And I think, to be fair, because I make the case for being an investor and not a saver, or mostly an investor and be a saver for a little bit, but also look to the taxes on savings that you have. And you might have to reach a certain threshold first, but then you will be taxed also on your savings account. So if you want to compare the two, I think that it is fair to also look to the taxes on savings accounts.
Got it. Cool. I'm going to go to a question from Marion. I'll put it on the screen, and it's again about taxes, but it's really just asking if Saxo deducts it or if they have to do it themselves. I guess this is going to differ by country, but generally, I think the answer.
No, normally there is dividend tax, and that is taken care of by the company that pays the dividend. If you own stocks and it's going well with the company, they have a profit, they want to redistribute some of the profit back to the shareholders, and it's called a dividend. And normally they pay it, and the dividend tax is withheld by them, by the companies paying the dividend. In the Netherlands, it is the case that you go to the taxes and you say, yeah, I paid some dividend, but I would like to reclaim that dividend tax that I paid, and you will get it back. But you have to do so. The withholding is done by the company, but reclaiming the taxes, the dividend taxes, you have to do yourself.
Okay, moving on to a question from Maria. I put it on the screen. So with the interest rate cuts expected this year, do you suggest to invest more in bonds? And in general, I guess that begs the question, how would you adjust bonds as the rate cycle does move?
Yeah. All right. What we saw the last decade, that quite a few years in that decade, bonds were not the place that they used to be. In the, call it the old school approach, you got savings, low return, very low risk, bonds, return a little bit better, but also a little bit more of a risk. And third, you got stocks, higher potential profits, but also more risk. And because the interest rates were close to zero, bonds were not interesting for retail investors. Now you see that bonds are regaining in that sequence of risk. They're regaining or reclaiming their place. So that's the good news. Interest rates uh, coming down. That is the assumption in the market. But you've seen already a big move, for example, in the 10-year in the US. It was 5.1% at a certain point, and we're trading now at 4.1%. Nevertheless, I think bonds are still good to have part of your portfolio allocated to bonds. And if you look to the shorter maturities, the 3 months, 1 year, and I'm talking about the USD bonds, they still offer very attractive yields. If you are a European and invest in US bonds, be aware that there is a currency risk. I mean, it is quoted in dollars. The coupon is paid in dollars. And if the dollar would decline to the euro, yeah, I mean, then you're going to lose some of your profits. So be aware of that. But for the question, the market is already anticipating for the interest rates to come down. I think a week and a half, 2 weeks ago, there was some questions about, yeah, will they really do it, or are they going to postpone it a little bit? It is still unclear. Our Chief Investment Officer, Steen Jacobsen, he expects that the Fed will start cutting in March already.
Sounds good, thank you. Here's a question from Andreas, talking about an English proverb. I know you like these proverbs, actually, about when blood is flowing in the street, it's time to invest, even if it's your own blood. Yeah. What do you feel about that? And does his question really is, does it sum up the resilience you need to have in the stock market?
Yeah, but it is what you also can have with that approach. When is the blood really flooding? So you're never sure. Is that with minus 15%? And then you say, no, it should be more bloody. I'll wait for minus 25%, and it doesn't come. So you didn't buy the dip, what was minus 15%. So you miss the way up. For easy investing, I like the approach of dollar cost averaging, and that is on a monthly basis, you put a certain amount of money in the market. But if you are say, yeah, but I want to be more in control and I want to time a little bit better, I think it is wise to always have some cash lying around. And that can be 10%, 15%, 20% of your net worth that is available for investing. And it will happen, I don't know when, nobody knows when, but we will experience a severe decline. And whether it will be 21% or 35 or 41, I don't know. But if you have some cash lying around, there must be, or there comes a certain point where you say, all right, I'm going to get in. And will it be scary? Yeah, it will be very scary, because there are, at those moments, and especially when the market is declining very hard, it all feels shaky. It feels like the end of the world. And then you have to say at a certain point, can be minus 20, can be minus 30%. All right, I'm going to put some extra cash in right now, because I think in the long term, it's a good time for buying. You are timing the market, and then scientific research show that it is very hard to time the market in a good way. But in this approach, I more or less I would say that you are a long-term investor, and if there is a decline, you do have still some cash hidden that you can use to make the best of the decline that is coming. Will it be scary? Yeah, it will be scary.
And to that, there's a follow-up question here, really. I'll put it again on screen. So, yeah, what size, percentage-wise or other, should you be putting aside for your emergency fund, like in cash?
Yeah, I think this is also very much about risk tolerance. What I see for myself, for example, that most of the time I've got quite some cash hanging around. But being not invested and the market going up, then yeah, I say to myself, well, wasn't I a little bit too much risk averse? If we would have a down year, I'm happy with the amount of cash if I didn't invest it during that time. So it is very personal, but think somewhere between 5 and 15%, just as a starting point. How does it feel if you would have that cash on your on the side? But also think about when are you going to buy, and if you are investing in ETFs and it are well-known indices, on what level will you be buying the S&P or the Nasdaq? And if you know that, you could say, I'm going to put the order in already because I know I will be a buyer at that level. And chances are big is that you won't reach it. And if the market goes higher in 2024, then your order, which you put in now 10% lower or 15% lower, might be 20 or 25% lower than the current market view, or the then market level. But I think it's good to think about it and have the plan already in your head, because if it happens, that you know that you were thinking about it and thinking about the scenarios when there was no stress in the market. The stress is there, and you can stick to the plan which you made when there was no stress in the market, so you are fully rational.
Cool. Right. I think we've got time for. Well, we are running out of time, really. Let's just try and wrap it up. There's a couple of fairly specific questions. Probably don't need very long answers. So one from Mick, who is asking
Let's make this the last one.
Yes? Sounds good. So this it should be fairly quick. He's looking to find. So he's looking at dividend yield ETFs, dividend yielding ETFs, or income ETFs, and where can he find the historical dividend returns that they've done to date? Can we do that on the platform, or do you have to go to the website?
With a little luck in stocks, you can do it on the stock level. You can find them. I'm 100% sure. For the ETFs, I think you can find them there in the screener as well. And then you could say, as a filter in your on the whole universe, the dividend yield must be at least 2% and max 5% or something. And then you would filter out the ETFs that have that. What otherwise could be helpful, that would be Morningstar. That's a worldwide data provider, I think covering 95% of all the ETFs available, and you can also use the screener there. But the first place to go is, of course, the Saxo platform. And I think, I'm 95% sure, that the dividend filter for ETFs is also in the columns available.
Got it. So yeah, Mick, go and check out the filter in Saxo. Sounds like you should be able to find it there.
Yeah.
Okay, cool.
Yeah.
That's a wrap. Thank you, Peter.
Yeah. Thank you for watching, and hope to see you next time.
Just before people drop off, there is a survey that I'll put the QR code on screen. So if you take a look at that, and if you are on a phone and you can snap it, then feel free to do so. And on there, you can just give a quick rating about how you found the session today, as well as giving some suggestions about other topics you might want to hear about in future webinars. So be very grateful if you do have the time to do that before you do drop. But other than that, thank you very much.
All right. Bye-bye. Thank you.